My name is Jeffrey Kennedy and welcome to Trader's Classroom. Today I want to review one of my favorite chart patterns of all times, and that's actually the head and shoulders formation. It was actually popularized by Edwards and McGee in their seminal work, Technical Analysis of Stock Trends. So let's begin. Now the actual formation of a head and shoulders is quite simple to actually observe on a price chart. What you actually have is a price high, or after an advance, prices peak up, and then they top out short term, pull back for a little while, and then they push to a new high. And then market comes down, and then we see a failure swing high. Now this would actually represent the left shoulder, the head, and the right shoulder. Now another exciting component of this actual formation is upon the completion of the pattern, which is essentially a break of the neckline right here, we can actually identify a trade target. And that would be simply measure the distance from the head to the neckline, and we project that downward from the breakdown point. So this distance right here between the neckline and the neckline measurement is simply the height of the head measured down to the neckline. It's a very easy pattern to identify on a price chart, and it's more commonly thought of as a bearish reversal pattern. I have more examples of it being a bearish reversal pattern, but even so, it does occur as an inverted head and shoulders, and is also a bullish reversal pattern at times. I would probably say maybe 60-40 or 70-30. And what I mean by that is most of the time, say 60 to 70% of the time, it will actually appear as a bearish reversal pattern. The other remaining, say 30 or 40% of the time, it's actually a bullish reversal pattern. Now, there's one more thing to remember about the head and shoulders formation. The larger the time frame, the more significant. And what I mean by that is if you see a head and shoulders formation on the weekly chart level, it's going to be much more significant than, say, a head and shoulders formation which appears on a daily chart level or on an intraday basis. That's another aspect of this pattern that I like, is that you can also use this or look for this pattern on intraday price charts. So let's walk through a few examples here, and I'll show you some classic examples of a head and shoulders formation. And the first one, or most notably, would be, here's a great example. This is in the Russell, and this occurred back in, well, you can see back here, back in 2006, 2007, and 2008, and then the 2009, the big sell-off we saw in 2008. Well, look what we have here. We have a nice left shoulder right here, then we have our head, and then as we moved into 2008, we had our failure swing high. Here's the neckline, simply connecting the extremes, the price lows between the left shoulder and the head and the right shoulder. And then once we saw the neckline break right here, we then were able to actually measure the distance from the head to the neckline and project it downward from the breakdown point. And as you can see, that's exactly where prices went in the Russell as we moved into 2009. Now, what's important about the neckline measurement to understand or remember is that it really only represents a minimum objective. So many times you'll actually exceed this, maybe moderately or sometimes quite extensively. But this is a great example of a head and shoulders formation, again in the Russell on the weekly chart level that occurred back in 2006, 2007, and 2008. Now, I would also like to mention, notice this neckline right here. Notice how it slopes. Many times when you're drawing a head and shoulders formation, the ideal example of a head and shoulders formation is to have a horizontal neckline. And essentially you want the right shoulder to kind of be of equal weight, both in price and time, to the left shoulder. But there are examples I have where you might see an upward sloping neckline, or possibly a downward sloping neckline, or if you're familiar with some of my work on a variation of this pattern, where I have it's called a head and half shoulder formation, where the right shoulder is actually a bit muted. It actually only travels about half the distance or height of the actual left shoulder. When this occurs, it tends to argue for a more impulsive or more volatile move to the downside. Now let's take a look at a few more examples. This is the Russell, and let's take a look recently what's occurred in the Dow Jones. Back here, back in March, we had a high price high. Here's our left shoulder. We came down, we pushed up. Here was the actual high that occurred back in, I believe, May, and then that would actually represent the head. Notice the downward sloping trend line in this instance, and then we bounced up. This was back in July, and then we actually saw the sell-off. Here was the nice head and shoulders formation in the Dow, left shoulder, head, right shoulder. Here's the neckline. There's the neckline break. Here's the initial neckline measurement target. And as you can see, we almost did twice the distance to the downside. So this is a great example of a head and shoulders formation recently in the Dow Jones Industrial Averages. Let's take a look at another great example. For many of you who are also subscribers to my Commodity Junctures work, I've discussed this head and shoulders formation before. It's been a while, but we have talked about it in soybeans. Here's an example of an upward sloping neckline where we have a left shoulder, the head, the right shoulder. Here's the neckline. There's the neckline break. The neckline measurement actually argues for soybeans to move down to about, say, $7 a bushel from current levels. And again, this is a monthly continuation price chart of soybeans. Now let's look at, say, for example, again, here's a good, well, actually this example here, the reason I like it is because it actually builds upon some of the lessons that we've been doing recently in Traders Classroom having to do with price gaps. In fact, I think we actually worked with LinkedIn and the price gaps it offered. But the reason I like this price chart here is this formation right here. Notice prices gap up and then they gap to the downside. This is an island reversal, but it also represents the head of a larger head and shoulder formation. Here's our left shoulder, here's our head. That's our island reversal. Here's our right shoulder. Notice the right shoulder travels about approximately the equal distance of the depth of the decline that we actually saw here. So this distance here is approximately the same distance we all saw over here. Also, I like the balance of time between the left shoulder and the head and the right shoulder. The neckline measurement comes down to about, say, $100 a share. And many times what happens when you penetrate a neckline is many times you'll see a small counter trend move back up. Test the underside of it. This is referred to as a pullback. Sometimes that may occur on, say, once or even twice, sometimes 3 times prior to the big break. My advice on that type of situation is the pullback occurs, it's 50-50. And what I mean by that is sometimes you'll see prices test the underside of the neckline, like I'm anticipating here in LinkedIn, and then we'll see further decline onto the downside. Again, this is referred to as a pullback, but in some instances, for example in soybeans, there really wasn't a test of the neckline. So I like to often wait for that counter trend move, that pullback or that throwback following a penetration of the neckline, but sometimes by waiting for that move to actually occur, sometimes it actually doesn't. So that's going to be up to you as far as how you want to actually trade the structure. Now let's take a look at an intraday pattern. Now this is in Disney, and this is one I've been kind of keeping my eye on here. It's a short-term pattern, but also too this is a good example of an inverted head and shoulders, a bullish head and shoulders formation on the intraday price chart level. Here we have a left shoulder, then we come down, make the head, bounce back up, come back down. Here's the right shoulder, and here's the neckline break. And really it wasn't until late yesterday that we began to decisively move above the neckline. So what do we do next? We simply measure the distance between the head and the neckline and project it upward from the neckline break, and that actually targets a level a little bit above, say, 110 in Disney. And this is a 15-minute price chart. Let's look at a few more examples. Now, I believe it was back in May or June I showed this example. This was another lesson on the head and shoulders formation. And here we identified a left shoulder, a head, a right shoulder, and then we also identified the neckline. And what I was looking for was either for prices to just continue higher to about the 90 handle or give us that pullback. Excuse me, this would be a throwback technically because the larger trend would be to the upside. And as you can see in this example of the head and shoulders, it failed. Well, that's just simply reality. Nothing works 100% all the time. Whether it's an RSI structure or a momentum pattern utilizing stochastics or a head and shoulders formation or an Elliott wave structure or an Elliott wave count, nothing works 100% all the time. But they are reliable enough that I do indeed look for them, and I'm actually very excited when they do indeed occur. But I wanted to show you this example just to give you a good idea of the reality of the market. It doesn't work all the time. But what we now can do with this issue here I'm not even going to try and pronounce the name, something 360. Ticker symbol is QIHU. But look what we can now do with the price action in this market. We can still do another head and shoulders formation, but this one would be bearish. Here's the left shoulder, here's the head, here's the right shoulder, and here's the neckline. Neckline measurement targets about, say, roughly $30 a share. So how does a head and shoulders formation actually fit into Elliott wave analysis? Well, Bob's written some excellent work on how many of the old school chart patterns that you work with, whether it's a triangle, a flag, a pennant, head and shoulders formation, whatever, it's very well incorporated into the Elliott wave structure or Elliott wave idea. But what's most important about the Elliott wave, what Elliott wave brings to the table, or what the wave principle brings to the table that the old school chart patterns miss, is context. For example, let's look at just this structure right here, and let's have just a little bit of quick fun. How's this? Okay, left shoulder, that's wave A. The intervening low between the left shoulder and head, we'll call that wave B. The head represents wave C of a zigzag. The initial decline is wave 1. Excuse me, let me put a wave 1 there. Here we have wave 1. Counter trend move up is most likely wave 2. So we can now expect selling down to about 30 in wave 3. So here's your Elliott wave count. And also here's your head and shoulders formation. Also too, what we know about, say for example, utilizing the Kennedy channeling technique, counter trend price action tends to be contained by parallel lines. Notice that. And also too, we can kind of get an idea of when our wave 3 will indeed be confirmed. And that's going to of course come with a decisive break of the lower boundary line of the base channel, which we almost achieved this week, but ideally we'll have, that will occur within the next few weeks once we begin penetrating the lower boundary line of the base channel. Very simple, very effective, so keep your eye out on this pattern because it many times, I would say more often than not, probably about 80% or better, it does indeed offer traders, I think, a viable trading opportunity. That about does it for today. Thank you very much and have a great week.